Well, Gavin, when we first met 3 years ago, we started talking about a book on emerging markets and frontier markets, and you had some very solid reasons why we should focus on frontier markets. Could you start with those?
Yeah. Well, as you know, Al, frontier markets are the less developed emerging markets. In essence, they're the ones that are the next generation of emerging markets. So they have lower levels of GDP, that's gross domestic product per capita, so people are poorer. They have less developed capital markets, and they're a lot less liquid. Having said that, they are 14% of the world population and 7% of world economic output, but they're less than 1% of world stock market capitalization. So if you assume that, first of all, they're going to keep on growing, which they've been doing extremely rapidly, in fact, they've been growing over 10% a year over the last decade, as opposed to, say, 5% for the major emerging markets. And secondly, that their stock market capitalization will rise to reflect some of this growth, then, as you remember we discussed, we felt that they could be as successful an investment as the emerging markets have been over the last 10 years, where you've effectively doubled your money.
We've suggested and we've talked about how these markets will, in the long run, pay more returns than the developed markets.
Yes.
And you had some very serious reasons for that.
Well, amongst them were the fact that they were pretty cheap. It's always a good thing to buy things when they're cheap rather than expensive, although ironically most investors end up doing the opposite because you buy the stuff that's gone up. Frontier markets haven't really got back to where they were before the financial crisis, so they're relatively cheap, although the index is about 15 times last year's earnings. A number of countries within the index are only at 11 or 12 times earnings, and the other point is they pay a really good dividend, 4.6% dividend yield on the frontier market index, so they're both cheaper and they give you a higher return. And as people come off the countryside into the cities, as incomes rise within the cities, as people start to get their first telephone and first credit card and first motorbike and drink their first imported bottle of beer, you have the opportunity as an investor of sharing in this process, which has happened throughout all the other emerging markets over the last 30 years.
So the rising consumer is probably one of the larger reasons why we're looking for these returns.
Absolutely. Effectively, most people want to have the lifestyle that we have in the West, and they want to have electricity and running water and the ability to get to work without having to walk for a couple of hours, and they like cell phones, and they'd like TVs and DVDs and the like. So if you are actually buying companies which service those consumer needs, which could be the telephone company or the utility or the consumer goods company or the auto company, and a number of those are actually based in Europe or North America or Japan, but are selling into these markets, as well as the companies that are listed in these markets, then we feel you do pretty well.